Hi and welcome back to the channel. We're back after a few weeks on vacation, so what better way to get back into it by uploading a video going over 3 UK stocks that look like good buying opportunities going into October. If you've watched any of my videos before, I might sound a little bit different as I've treated myself to a nice new microphone as well as a nice new PC, as the one I was using was 8 years old and it only cost about £600 at the time of buying, so you can imagine the lack of spec within it, and it was grinding to a halt. So we've had a nice upgrade overall and we're ready to keep things moving. These are the 3 stocks which I believe look fairly valued and good long-term buys at the moment. 2 of these companies will be reporting earnings in just a few days' times after uploading this video, so some of the information used is in relation to the latest trading report or the last earnings report. But I feel that BOOHOO and WETHERSPOON will have good earnings to report due to strong economic conditions, each within their respective industry, although I do expect supply chain issues to feature on these earnings reports. BOOHOO will be good for the reopening trade with people back out and about, socialising in outdoor settings, such as Wetherspoon's, and they'll need to refresh their wardrobe. And I think that Wetherspoons will report strong earnings due to the fact we've had a really good period of weather over the summer, and people have been back out and about, socialising in venues such as beer gardens. Also, the fact that restrictions were removed on the 19th of July sets it up nicely for a turnaround in my opinion. We can check back these results when they release their earnings and see what these companies are saying. Let's get diving into what these companies can offer investors. First company we have is BOOHOO, who are quickly developing into the UK retailing giant. They design and sell clothing, shoes, accessories and beauty products and have very strong brands under their banner with the likes of Boohoo Man, Pretty Little Thing, Oasis and Warehouse, as well as others. They offer everything and anything from head to toe, jumpers to swimwear, jackets to underwear, so they have a hugely robust product catalogue. Sales have been performing exceptionally well, with the growth seen from 2020 into 2021 firing on all cylinders, with the UK reporting growth of 40% and the US with eye-watering growth of 65%. They've been very busy in the M&A department, not afraid to pay big to get big brands under their name, with £324 million acquisition of Pretty Little Thing, who racked up net sales of £516 million in 2020, and then in this year they purchased the Debenhams name and the website for £55 million. Debenhams has been a struggling retailer, and with the pandemic hit, they could no longer continue, and the 242-year-old department store sadly closed down the remaining 118 stores, with at least 10,000 people losing their jobs in the process. Now let's dig into the past revenue, predicted future growth and the balance sheet. From 2019 into 2021, sales more than doubled from £857 million to £1.7 billion, with analysts expecting this to double from here out to 2023 and 2024, generating net sales of close to £3.5 billion. EBITDA is also expected to follow this upward trend, also more than doubling, and guess what, so is earnings per share. The balance sheet is in pristine condition, sitting on a hoard of cash right now at about £350 million, which I'll show you in the next slide or so, and this allows BOOHOO to continue their acquisition streak, which I strongly believe they will, and there's a new retailing stock that's just went public, who I wouldn't be surprised to see them going for, which I'll cover in a minute or two. For me, revenue growth in the balance sheet can't be faulted at this stage. I've got their Q3 trading update here showing 3 months up to May 31st. Group revenue jumped up 45% from £254 million to £367 million. BOOHOO are really established in the UK and they still reported 30% growth, but I really like the growth shown here for the rest of Europe and the USA with 66 and 79% respectively. And at the bottom left they have provided an update on their newest brands, saying that they're all performing well and are now fully integrated within the company. As I mentioned just a short while ago, BOOHOO will be performing more merger and acquisition activities, as they've said so themselves, and in the cycle section they've raised nearly £200 million, with the cash sitting at a very healthy balance at about £350 million. Outlook for the year is to deliver another strong year of growth, but they do have a few sections they're calling out which may be slightly damaging to sales. They mentioned that the market will become more competitive, likely due to the fact that physical stores are now reopened, and also carriage inflation costs for some overseas markets which could eat any profits. This is the company here who I think that BOOHOO will be making a move for sooner rather than later, and this is a newly IPO'd company called IndieStyle, who are currently valued at about £85 million or so at the time of recording this video. With revenue of £45 million last year, IndieStyle collabs with TV personalities offering women's ranges, and it's just recently sold off in the share price as they've issued a cautious profit warning due to supply chain issues. The share price is around the £2.60 to £2.70 range and is right around its 52-week lows. If I insert the 5-year chart, you can see that right around this level it offers a bit of support, and with earnings just days away it could offer a real bounce. Current PE is quite steep at 37, and if we calculate the forward PE from the 2022 forecast, it's around the 33 to 34 range, which if we compare that to years gone by, is far less of a premium as to where it usually trades. Price targets from 18 analysts on average have it at £4.47, giving it a 72% upside, with even the lowest price target proposing a 12% return. 9 buys, 7 outperform, 2 holds, and 1 with no opinion. And you can see from the heat chart shown on the far right that the changes have recently been upgraded, with no one saying that this company is at a sell stage. Next stock we have is JD Wetherspoon. If you're over 18 and you live in the UK, you'll likely know who this company is, as you've probably been in one of their pubs at some stage in your life. They own a large chain of pubs and hotels, with roughly 879 pubs and over 58 hotels. Pubs, clubs and hotels are one of the most badly hit industries over the last year to 18 months, and you can see that with the 2019 to 2020 sales comparison, all heavily reduced with a 30% total drop over that year. I believe that Wetherspoons is part of the British pub and drinking culture, which I see slowly but surely returning to previous levels in the near term. Things were going pretty well for Wetherspoons up to 2020, with revenue and earnings being pretty stable, but with COVID that all changed, with revenue in 2020 coming in at just over £1.25 billion for the full year, whereas in 2019 it was sitting at £1.8 billion. For this year in 2021, it's expected to be a total shocker, with only sales of less than £800 million, alongside reporting a loss for both years 2020 and 2021. However, I think that they can return to former glory, as do analysts expecting revenue to be returning to pre-COVID levels next year in 2022. The balance sheet isn't in the best condition, to be totally honest, which can be expected due to being heavily exposed to real estate, and with no positive earnings the last 2 years, this certainly wouldn't have helped them, so that would be one cause for concern. However, saying that, from an operations point of view, things look to be making a comeback, which we'll glide through just now. This information is all taken from their interim results, which only covered up to March 2021, with their next report due on the 1st October, which is bad timing for this video, as it'd be good to use more up-to-date information. However, we can still use this to establish a bull or bear thesis going forward. They scored 4.96 out of 5 for food hygiene, being rated extremely high on the food hygiene ratings, being number 1 rated pub, which is really important as the food is becoming more a viable source of revenue than it has done before. Revenue has been absolutely hammered recently, but we can look back on the last 10 years of information, with most years reporting growth, with all 10 years having positive like-for-like sales up to 2020. Free cash flow per share and profits have been moving in the correct direction for a long time, and if they can bring this back, they should be able to chip away at the debt level over time. Average weekly sales per pub for the last 10 years is looking robust, showing continuous improvement, and with a huge drop off in 2020 and 2021. Earnings per share has been mainly good and up to the right, as they say. Since 2000, their sales mixture has been gradually changing, moving away from more bar related revenue, which in 2000 was 76% of their revenue, and since then food has become an ever increasing source of revenue, which circled back to the point of how important the food hygiene score is. Debt levels, as said, is quite high, with debt at about 800 million, so that's the only thing I'm not a huge fan of this company. On the property side of things, pubs have been varying over the last 10 years, ranging from 775 properties in 2011 up to a high of 951 in 2016, and now it currently sits around 872. Hotels have been increasing from 22 in 2011 to 58 in 2021. They now have a presence in Ireland, growing from 1 pub in 2014 to most recently having 7. This was the outlook given back in March, and you can get that they're not happy in the slightest with the restrictions that were imposed on them at that time. Now all fully removed, this should allow them to get back on track to growth and profitability. No PEs in this stock, as it still reports negative earnings. Share chart shows a 22% decline from 52-week highs, and we've got a bit of a coincidence here as I overlay the 5-year share chart, as we're bang on a support level as we were with BOOHOO. Price targets are more volatile, with 11 analysts here of the average price target of just under £14, giving potential upside of 27.7% from current levels. And the third and last UK stock for this month is Smith & Nephew. This company specialises in medical technology, developing, manufacturing and selling all kinds of medical devices, which include sports medicine, joint repair, arthroscopic enabling technologies, and advanced wound care, offering products from bandages all the way up to hip and knee replacements, as well as including equipment to help carry out surgical procedures. They're a British multinational company with a high presence around the globe, with the majority of their income coming from the US, which makes up roughly 50% of their sales. Sales have fallen within the last 18 months or so, as hospitals and medical centres have been dealing with COVID-related illnesses, meaning that non-urgent treatments or surgeries like hip replacements have been delayed, equating to reduced sales across their main three segments. With hospitals resuming these type of procedures, I think that demand will be here for these type of products. Smith & Nephew are more of a steady Eddie company, offering consistent single-digit growth over many years. Even though 2020 was a bad year, they still had revenue of $4.6 billion, with positive earnings showing resilience in times of turbulence. Forecasts out to 2023 are showing consistent growth metrics across sales, EBITDA, net income and dividend payments. The balance sheet is in good condition, with debt levels highly manageable, not going above the 2x leverage threshold that we like to see. Things are forecasted to get better here on out, with debt being paid down over time. Now time to scan through their Q2 earnings. Improved growth in Q2 as markets begin to recover. On track for 2021 revenue and margin guidance, delivering on top line growth driving further operational improvement. Q2 revenue by region is now showing huge growth in Q2, where beforehand sales had been declining. US moving towards normal activity, with other established markets soon following, with emerging markets still trailing, but it's had 2 consecutive quarters of growth. Breaking it into the 3 franchises, total growth of 40%, which is promising across all divisions. Orthopedics making up the majority of the revenue, but the best growth can be seen in sports med and ENT. Comparing the latest reports to 2019 levels by franchise, the only area not back to current levels is orthopedics, which is still down 6%, and by geographic split, the US is the only area with positive growth. So things are getting there. Not all areas are recovering in harmony, but long term all franchises and areas will be turning to growth. Reinforcing the franchise performance in the last quarter, orthopedics had a huge jump by 43%, showing demand is returning, with knees and hips making up for the majority of the revenue. Sports and ENT with overall 51% growth, showing another positive indicator here. Advanced wound management with strong results of 27% growth, following on from 9% growth in the previous quarter. Half year trading income shows increasingly strong performance, of revenue up 28%, gross profit up 32%, trading profit up 166%, with earnings per share up over 100%, now back to covering the dividend payment. The balance sheet is in good nick, with net debt of just over $2 billion, which is still very manageable at current rates. 2021 outlook has been reconfirmed, with the target underlying revenue growth of 10 to 13%, trading margin range of 18 to 19%, and all targets assume surgery levels largely unconstrained by COVID in the second half of the year. They are closing or selling 5 smaller sites and constructing a large-scale multi-technology facility in Malaysia, which is almost complete and will be up and running in 2022. The share price is right around 52-week lows, and it still has a high PE of about 29. Forward PE, if we calculate that ourselves, is around 25 to 26. And guess what? If we overlay the 5-year chart, it also shows that this has tested this level more so in recent years. And if we go out once more to the maximum share chart, you can see how well this has performed over time. Likely why we have such a premium PE ratio, and the bonus on top of this is that if you buy this stock, you'll get a nice 2% dividend yield, and the dividend payment will likely grow over time. Price targets from 15 analysts show a target price in dollars of $22.63, giving a near 25% gain, with a very high margin of difference between the low and high price targets, which are $14 and $28, with 100% between them. We've got 4 buys, 4 outperform, 4 hold, 1 underperform and 2 sells. So that finishes up nicely with this video. If you're still watching at the end and enjoyed it, please drop it a like and leave a comment on what you think of these companies, and I'll catch you on the next video.